We haven't felt the full impact of the US tariffs yet. We see governments engaging in large infrastructure projects, and that's going to fuel investment. They actually stand to benefit from the AI boom through the greater demand for goods they produce.
Higher deficits, more trade turbulence, and a somewhat unclear path ahead. We're interested in how smaller economies have dealt with tariffs and the general turmoil surrounding trade. Beata Javorcik is chief economist at the European Bank for Reconstruction and Development, which provides development financing for parts of Europe, Africa, and the Middle East. She joins me now. Beata, welcome. You know, your new report looks at the economies in regions where the bank is active. And what I took from it is that you found that economies did actually better than expected last year, despite all the chaos that we read about in the headlines. Did we overestimate the significance of these global tariffs?
I think we did. And the impact of tariffs last year was limited. And that's because a lot of exports managed to enter the US market before tariffs were introduced. So in other words, thanks to front loading, we haven't felt the full impact of the US tariffs yet. As for the changes announced in the past few days, they are not going to make big difference for the economies where the EBRD operates. However, some smaller countries, such as countries in the Western Balkan region or Jordan, actually could see their tariffs go down.
Before we get into some of those countries, I want to ask, you mentioned, of course, the new tariffs recently mentioned, or some of the changes mentioned in the past months, but you also said that a lot of importing was front-loaded. A lot of people tried to import and get ahead of those tariffs in 2025. Doesn't that suggest that 2026 is when things could actually get worse, since now the tariffs are in effect, they're even changing constantly, and there's less time to really get ahead of those that already happened?
So indeed, the full impact of the tariff has not been felt yet. However, it's worth mentioning that for countries Eastern Europe, Central Asia, or North Africa, the US tends not to be a very large market. So they are more affected indirectly through the impact of US tariffs on the German economy and German demand for exports from those countries. And these are exports of both goods and services, exports within the supply chains for the automotive sector, for the machinery sector, but also exports of consumer goods.
You know, it's interesting because when we talk about trade and the trade turbulence of the past year, we talk so much about China, the US, India, and of course, in our case, Germany. What do these smaller economies that you're looking at, you mentioned Eastern Europe, you mentioned North Africa, for example, and Central Asia, what do these smaller economies have in common when it comes to economic profiles?
Well, in international trade, the law of gravity applies, and that means that you tend to trade more with markets that are larger and markets that are nearby. And that's the reason why the US market is less important for those countries, and the reason why German market is a key export destination.
The German economy is struggling and has been struggling for the last 2 years, 3 years actually. What does it mean for these economies that are so dependent upon it?
Well, how well German economy does spillovers into the region, not only into Central Europe, but also in broadly defined European neighborhood that includes Western Balkans, Southeastern Europe, North Africa. Germany is an important market, not only for goods, but also for services. So for weakness of the German automotive sector lowered demand for services exports of IT firms from Romania.
When we look at a lot of these nations, we see that inflation rates have fallen, but we see that real wages have yet to catch up. What effect does that have on public sentiment, on public perception of the economies?
Well, look, inflation has eroded the purchasing power of wages in all of our regions of operations. In particular, in Eastern European EU member states, real wages are well below the pre-COVID trend. In contrast, in Central Asia and Western Balkans, real wages are above pre-COVID trend. So there is a trade-off here. Lower real wages boost competitiveness of the countries as producers of exports, but of course, lower real wages are eroding living standards.
Looking at 2026, you've adjusted forecasts for 2026 slightly upward for a number of economies this year. You mentioned this earlier. After the Greenland episode in which new tariffs were threatened and ultimately didn't happen, and then the recent Supreme Court ruling, it's clear that the tariffs issue isn't over this year. How would you look at 2026 when you see that everything is still somewhat in play?
Well, we think that this inflation process, which has continued in our region of operations, is going to fuel consumption, so that's a good thing. We see governments engaging in large infrastructure projects, and that's going to fuel investment. So in other words, we are going to see internal sources of demand driving growth rather than external environment.
Speaking of large infrastructure projects in the US, AI is really driving the economy there, this effort to build more data centers. It's also having an effect elsewhere. What result would an AI bubble have on smaller economies? And looking at it the other way, what result does this kind of AI boom have on smaller economies?
The AI boom has increased demand for goods related to data centers, goods related to computer vision, to data processing. And some of our countries, including countries in Central Europe, tend to produce these goods. So they actually stand to benefit from the AI boom through the greater demand for goods they produce.
You've touched on this, but this division between China and the US that's been growing over the years, some of these economies may have more relations with one than the other. They may not be huge trading partners with the US. But what does this kind of growing division between the two sides mean for all of these other economies?
Well, there was a lot of fear that the decline in US imports from China would result in trade deflection, in Chinese goods flooding markets in other regions. So far, we have not seen that happening in our regions of operations. Now, another implication of the tensions between the US and China is that foreign direct investment is much more driven by geopolitics than before. And that means that countries in Central Asia and other countries that are pursuing multi-vector geopolitical strategies tend to become more attractive destinations for investors from various parts, both from China and the US, from Europe, as well as from non-aligned countries. So they actually can stand to gain from increased FDI flows thanks to their neutrality in this conflict.
Your report also notes that countries have expanded and diversified their exports over the past 2 decades, but their exports are increasingly in conflict with China in the sense that there's a lot of overlap between what China exports and what they export. How problematic could that be for some of these economies?
Well, it is a challenge. Chinese export structure is much more sophisticated than what you would expect given Chinese level of income per capita. And that means that China is a formidable competitor, not just for emerging Europe, but also for Western Europe. Now, when you look at China as a destination for exports from our regions, so far there has been a shift away from the goods that our regions produce. So yes, commodity exporters stand to gain a lot from selling to China, but for countries in Central Europe, it's becoming increasingly harder to supply goods that China demands.
All right, that's Beata Jaworczyk. She's chief economist at the European Bank for Reconstruction and Development. Beata, thank you for your time.
Thank you very much, Stephen.